Assalamualaikum and hi, my name is HFT20303. My metric number is HFT2030455. I will present about introduction. So for introduction is report, analyze and compare the financial performance of Genting Berhad and Shangri-La Hotel Malaysia Berhad for the financial years 2023 and 2024. These companies were selected due to their significant roles in Malaysia's economic recovery post-pandemic, especially within the hospitality and tourism sector. The analysts apply financial ratio to evaluate liquidity, efficiency, management, and profitability. The main objective is to determine which company is more financially stable and has strong growth potential to responsible resources management. Next is background of the company. For Genting Malaysia Berhad, Genting Malaysia Berhad founded in 1965 by Council Lim Botong. Genting is Malaysia's largest multinational company in the hospitality and entertainment. Its flagship resort Genting in Pahang includes a hotel, theme park, and a casino. The company also operates globally in countries like Singapore, the UK, the US, and the Bahamas. Genting has diversified into sectors such as power generation, cruise lines, and real estate, while embracing innovation and sustainability. Shangri-La Hotel Malaysia Berhad, a subsidiary of the international Shangri-La Group, headquartered in Hong Kong. In Malaysia, it manages luxury properties including Shangri-La Kuala Lumpur, Rasa Sayang Resort in Penang, and Tanjung Ar Resort in Sabah. Shangri-La focus on the high-end market, offering personalized guest experience and world-class service. The company also emphasizes green practice and social responsibility in its operation.
Assalamualaikum. Good day everyone. My name is Nur Fatihah binti Muhammad Sofyan. My metric number is H23A1724. Today I will be presenting an analysis of three key financial ratios: current ratio, quick ratio, and net working capital. Let's begin with the current ratio first, which measures a company's ability to pay off its short-term liabilities with its short-term assets. In 2023, the current ratio was 2.11, which indicates that the company had RM 2.11 in current assets for every RM 1 ringgit of current liabilities. In 2024, this ratio slightly decreased to 2.04. Although there is a slight decline, both years show that the company maintains a strong liquidity position as values above 2 are generally considered healthy in many industries. Next, the quick ratio, also known as the acid test ratio, refines the current ratio by excluding inventories or other less liquid assets. In 2023, the quick ratio stood at 2.09. In 2024, it decreased slightly to 2.02. Similar to the current ratio, the quick ratio remains above 2 in both years, indicating that the company is not heavily reliant on inventory to cover its short-term obligations. This is a positive indicator of liquidity strength. Lastly, we examine net working capital, which shows the difference between current assets and current liabilities. For 2023, the net working capital was RM56130.80 millions. In 2024, it decreased slightly to RM53491.30 millions. This shows that while the company still has a positive working capital, meaning it can cover short-term obligations, the decline suggests a marginal reduction in excess liquidity or short-term financial flexibility. Overall, although there are slight decrease in all three metrics from 2023 to 2024, the company still maintains strong liquidity and is in a stable financial position. Thank you.
Today I will be presenting an analysis of Genting Company activity ratio for the year 2023 and 2024. This ratio helps us understand how efficiently we are utilizing our asset and managing our operation. First, total asset turnover. In 2023, our total asset turnover was 0.25, and in 2024, sling increased to 0.26. This included a marginal improve in how efficiently we are generating sales from our total asset. The upward trend, as shown in the graph, suggests we are making better use of our resource year of year. Second, account receivable turnover. The account receivable turnover increased from 7.33 in 2024 to 7.53 in 2024. This means we are collecting receivables more frequently through the year, reflecting better credit management and faster cash flow. Third, average collection period. The average collection decreased from 49.81 day in 2023 to 48.59 day in 2024. A shorter collection period is a positive sign, indicating we are collecting payment from customers more quickly, which improve our liquidity. Next, inventory turnover. Inventory turnover declined from 22.25 in 2023 to 21.15 in 2024. This line decrease suggests that inventory is moving a bit slower, which could mean excess stock or slower sale. We should monitor this trend to avoid potential overstocking issue. Lastly, fixed asset turnover. Fixed asset turnover dropping significantly from 1179 in 2023 to 524.94 in 2024. This sharp decline indicates that our sales generating per unit of fixed asset have decreased, which may be due to increased investment in fixed asset for undergraduates. This is an area that needs further investigation and action.
In 2024, Genting Berhad showed a slight improvement in a debt ratio, which declined to 47% from 49% in 2023. This indicates a marginal decrease in the proportion of total asset financed through debt, suggesting whether asset management or a reduction in relative liabilities. However, the debt-to-equity ratio increased from 90% in 2023 to 96% in 2024, indicating that the company relied more on debt relative to its equity base, which could reflect increased financial leverage or slower equity growth. Additionally, the time interest earned (TIE) ratio, which measures the company's abilities to meet its interest obligation, decreased from 2.83 in 2023 to 2.57 in 2024. While the TIE ratio remains above 2, which is generally considered acceptable, the decline suggests a reduced buffer for covering interest expenses, potentially indicating higher financial risk. Overall, while Genting Berhad slightly improved its debt ratio, its increasing leverage and declining interest coverage warrant careful monitoring.
Hi, my name is Muhammad Aiman bin Maknawi. My metric number is H203A1714. Let's start with the return on equity. In 2023, ROE was 3.00% and it increased to 3.5% in 2024. While this seems like a positive sign, the increase may be due to a decrease in shareholder equity rather than a real growth in profit. So, despite the higher percentage, it actually indicates a decline in efficiency in generating profit from equity. Next, the return on assets. ROA dropped from 1.43% in 2023 to 0.83% in 2024. This shows that the company became less efficient at using its assets to generate income, possibly due to lower profits or underutilized assets. Lastly, the gross profit margin improved significantly from 25.13% to 38.3%. This suggests better control over the cost of goods sold. Even though total revenue may have declined, the company managed its production or purchasing costs more efficiently.
Hi, my name is Wan Muhammad Afizi Bewa Mustafa. My metric number is H23A2264. I will continue from a previous page. Now, let's take a look closer at the operating profit margin. In 2023, it was 15.98%, and in 2024, it slightly decreased to 15.9%. Although the change is small, it still indicates a minor drop in the company's efficiency in managing its core operating activities. This could be due to a rise in operating costs like salaries, raw materials, or administrative expenses that are not fully matched by revenue growth. It means the company is spending just a bit more to generate the same amount of operating income. Now we're moving on to the net profit margin. It declined from 3.54% in 2023 to 3.4% in 2024. This shows that after all expenses, including interest, taxes, and any one-off costs, the company is keeping slightly less of its revenue as final profit. One possible reason could be higher financing costs, increased tax liabilities, or even lower non-operating income in 2024. While the drop is not alarming, it does suggest the company may need to control costs more tightly or find ways to improve efficiency at the bottom line. That's all from me. Thank you.
Genting Berhad has a stronger liquidity position than Shangri-La in 2023. Current ratio Genting 2.11 versus Shangri-La 0.69. Quick ratio Genting 2.09 versus Shangri-La 0.68. This means Genting is more capable of covering in short-term obligation. Net working capital Genting shows significantly higher working capital 56,150 compared to Shangri-La, reflecting smaller short-term financial stability. Outperformed Genting in operational efficiency in 2023. Account receivable turnover Shangri-La 15.57 Genting 7.33. Shangri-La collects debt faster. Average collection period. Shangri-La take 23.44 versus Genting 49.81 days. Shangri-La gets paid quicker. Inventory turnover. Shangri-La 147.34 versus Genting 22.25 higher turnover indicate better inventory management. However, Genting fixed asset turnover is extremely high versus Shangri-La, possibly due to different asset structure. Debt ratio. Debt ratio Genting 47% versus Shangri-La 29% in 2022. Genting has higher reliance on debt. Debt to equity ratio. Genting 69% versus Shangri-La 47%. Genting is more leveraged. Time interest in Shangri-La 5.08, Genting 2.57. Shangri-La has more earnings to cover interest expense, indicating stronger interest coverage. Profitability ratios. Return on equity ROE Shangri-La 2.67%, slightly better than Genting 3.0%. Return on asset ROA Shangri-La 44.51% is significantly better than Genting 1.43%. Gross profit margin Genting 25.13% versus Shangri-La 0.06%. Genting has much more better gross margin. Operating profit margin Genting 50.98% versus Shangri-La 7.53%. Genting managed operation more profitability. Net profit margin Shangri-La 4.06%, slightly higher than Genting 3.54% in 2023.
Hello, today I'll be presenting a brief comparative financial analysis between Shangri-La Hotel and Genting Berhad for the year 2023. Starting with liquidity, Genting Berhad clearly outperformed with a current ratio of 2.11 and a quick ratio of 2.09, while Shangri-La stands below 1 for both, indicating weaker short-term financial health. In terms of activity ratios, Shangri-La shows stronger efficiency with a total asset turnover of 0.40 and an impressive inventory turnover of 147.34, far ahead of Genting's 22.25. Looking at profitability, Shangri-La leads in return of asset at 4.51% and return of equity at 3.670%, but Genting excels in gross profit margins at 25.13%, significantly higher than Shangri-La's. Lastly, in debt management, Shangri-La appears more conservative with a lower debt to equity ratio of 47% compared to Genting 69% and a stronger interest coverage ratio of 5.08. So in conclusion, Shangri-La demonstrates operational efficiency and lower debt risk, while Genting shows stronger liquidity and profitability in gross margins. Thank you.
Overall analysis. Genting Berhad outperformed in liquidity with a current ratio of 2.11 and quick ratio of 2.09 in 2023, indicating it could be easily meet short-term obligations, unlike Shangri-La, which ratios were below 1. However, Shangri-La was more efficient in activity ratios with faster assets turnover, a 23-day collection period compared to Genting's 49 days, and high inventory turnover. In terms of debt, Genting had moderate leverage and managed interest payments well, while Shangri-La maintained lower debt with stronger interest coverage. Profitability-wise, Genting had higher gross and operating margins, showing better expense control, although Shangri-La had a slightly better net profit margin. Overall, Genting Berhad proved to be the stronger company due to its solid liquidity, stable profitability, and balanced financial management.
Lastly, the conclusion is Shangri-La Hotel is a more efficient with a higher asset and inventory turnover, better return on asset, and lower debt level supported by strong interest coverage. In contrast, Genting Berhad shows stronger liquidity through a higher currently and quick ratio and greater profitability with a higher gross and operating margin. Overall, Shangri-La asset in efficient and debt management, which Genting is strong in liquidity and core profitability.